Well, let's start off perhaps with your perspective on the Nigerian markets right now and the kind of progress we've made year to date on that front.
Sure, it's a year I think many have been waiting for. We've had three rather difficult years, but this year I think the factors that could drive a decent rally came together at the start of the year in the form of cleaned up banks, balance sheets, and growing economy. So the two together basically led to, I guess, the 30-ish% year-to-date performance we've seen on the markets.
Taking a look at that then, what's your view on the financial markets specifically? Because we've had, yes, the banks driving a lot of the performance on the markets, and of course this on renewed confidence within that sector, but it also means that the opportunities to be picked up become a little bit more scarce.
Yes, that's true. I guess if you look at maybe some of the tier 2 names in the banking space, they've gone up quite a lot. Some of them have doubled. I think I remember mentioning that was possible on this program also in February or March. I think going forward, some of these banks are still trading on 0.5 times book, 0.6 times book. So if they can keep the earnings momentum that we saw through the first half and 9 months of this year going forward, then there is still some upside left. It's just that it's a bit more difficult to bang the table on some of these names. So there's still some upside.
So let's look at the risks, though, that do present themselves to the earnings momentum that we have seen.
Sure. I think the first, on the banking side, the first question is whether some of the deals that the banks are looking at for Q4 specifically will crystallize. A lot of them have mentioned that there are some reform programs that are leading to opportunities in power, oil and gas. I think we've seen some movement on that front. So hopefully those deals will come through, but there's a risk that they'll be pushed into Q1 as well. But a plus or minus 1 quarter error margin I think the market would accept that. On the consumer side, I guess the near-term concern is inflation, plus some of the flooding problems that we've had in Nigeria. So I think there's more headwinds on the consumer side than the banking side.
Yeah. What's your view on the overall macroeconomic picture over in Nigeria right now? Because, of course, that is something you're going to have to take into consideration, where the consumer is ultimately affected by it. And as you say, a ripple effect onto a bank's earnings potential moving forward.
Yeah, I think we have 7% GDP growth for this year. I guess, compared with a lot of the other, so even frontier emerging markets, that's not a bad number. So yes, it's not 9%. I mean, for example, if power in Nigeria was fixed, maybe we'll be talking of 10, 11, 12%. But 7% is a decent number. And I think that as long as the markets observe that on the fiscal side, there are some conservatism built into maybe next year's budget. Whatever compromise is reached between the legislator and the executive, I think that will give some confidence going into next year. So we're not too concerned about the macro side of things. I guess if you are a very large multinational in the consumer space in Nigeria, and you can't remove yourself fully from some of the problems we've seen, for example, in the north and the floods, then yeah, you may see a bit of a quieter Q3 than normal, for example, in cement. But beyond that, these are temporary factors. I would expect to see some catch up or rebound beyond the near-term issues.
So let's shift focus then to the non-financials of the Nigerian market and take a closer look at what's been getting your attention and propping up on your radar screen.
Well, yeah, I think a lot of the multinationals, the dominant ones have multinational parents. So they dominate their markets, and even if there's a wobble in the sector in a given period, you probably see a catch-up. So if they have a weak year, then maybe next year will be much stronger. So they tend to do pretty well over a business cycle. I think this year has been particularly odd because the earnings actually haven't been extremely strong on average across the board. but you've seen these names move up 40, 30, 50, 60%. The debate now is whether the valuation gap between the Nigerian names and their multinational sort of subsidiary peers has closed forever. We're still not sure whether that's the case. We think there's a potential risk that we may see a mild correction before we get to something that I would say is a new normal. I mean, in the past, these companies would trade between 20 and 25 times PE. Now they're trading close to 30 times.
So what's the rationale, the main rationale behind the kind of ramping higher that we're seeing of these various share prices? Because as you say, it's been a pretty tepid earnings season.
Well, I'll say there's a, for the non-financials, yes, but it's also mixed. So if you look at, for example, the sugar name that we have listed in the NSE, Dangote Sugar, the earnings in Q1 and Q2 doubled year on year because sugar prices were relatively low. But if you look at the other consumer names, whether it's flour names or some of the brewers, you'd see that it's not, you can't pound the table easily on them. So there's a bit of, the banks have gone up a lot, so maybe we need to find other names that haven't done as well. But also there's also some effects of QE3, even though we can't really show you exactly how the two correlate properly, as well as some artificial factors like market making in Nigeria. So I think all these things sort of come together to ensure that the non-financials are not left behind. But as I said, 30 times is not cheap, even in Nigeria.